Today, we're going to unpack the financials of FirstCry. Now, for the first part of 2024, this company looked like it was on an absolute tear, heading for some serious profitability. But, as you'll see, the full story is, well, it's a lot more complicated. It's a story about a massive gamble that could define their entire future. So here's how we're going to break it down. We'll start with who FirstCry actually is. Then we'll look at their amazing, profitable start to the year. After that, we'll see how the whole story changed in the third quarter. We'll figure out where that huge loss came from. And finally, we'll ask the big question. Is this all just growth at any price? Let's dive in. All right, first things first, let's get clear on exactly who we're talking about in this financial roller coaster. So the official corporate name you'll see on all the paperwork is Brainbees Solutions, but let's be real, the brand that everybody knows, the giant in the baby and maternity world, is, of course, FirstCry. Now, what's really interesting is that in their early reports this year, FirstCry's business looked incredibly simple. It was officially just one thing, a single segment focused completely on baby and maternity products. Now, remember that because that little detail is a huge piece of this puzzle. Okay, so with that really clear focus, how did their year kick off? Well, to put it simply, the first half of the year looked fantastic. In the first quarter, from April to June, the company turned a nice, solid profit of nearly 2.4 million rupees, a good, healthy start to the financial year for sure. But then, you get to the second quarter, and wow, things really took off. They reported a profit of almost 69 million rupees. I mean, that's not just a little jump, that is a massive leap. If you're an investor, this is exactly what you want to see. It signals that the core business is absolutely on fire. And this chart really puts it all into perspective. I mean, look at that. Going from $2.4 million to almost $69 million in a single quarter, that's the kind of explosive growth that gets everyone's attention. At this point in the year, FirstCry looked like an unstoppable rocket ship. The company was profitable. It was growing like crazy. Everything was heading in the right direction. So what could possibly go wrong? Well, this is where the story gets really, really interesting. So let's talk about the third quarter. This is where everything seems to flip on its head. And it's not because of a sudden collapse in sales or anything like that. No, it's because of a really crucial change in how FirstCry started presenting its financial numbers. This slide shows you the exact shift. See? In the first half, the reports were standalone and single segment. They were basically just showing us the core business. But in Q3, bam, they switched to consolidated and multi-segment. Now, this might sound like some boring accounting change, but trust me, it changes everything. It means we're finally about to see the full, unfiltered picture of the entire company. So what's the big deal here? Well, think of it this way. A standalone report is like looking at the sales from just one really successful store in a big chain. It looks great, but a consolidated report shows you the numbers from every single store in the chain, including all the new ones that are still losing money, plus the cost of running the headquarters. For the first time, we're about to see how the entire FirstCry machine is really doing. And what did that complete picture actually look like? Well, after seeing those incredible profits, the consolidated numbers revealed a pretty shocking twist. For the first 9 months of the year, a staggering loss of over 1.5 billion rupees. Wait, what? How does a company that was so profitable just a few months earlier suddenly find itself so deep in the red? Well, let's dig into the new numbers to find out. And the answer is right here in this table. This is crucial. Just look at that top line, the India multi-channel segment. That's the core FirstCry business we all know. And guess what? It's incredibly profitable, making almost 1.8 billion rupees. The massive overall loss is coming from two other areas, Globalbees, which is an investment arm, and their international operations. Together, those two segments lost almost 1.8 billion rupees, completely wiping out the profits from the main business. So when you put all these pieces together, what does this story really tell us? It actually reveals a classic and pretty high-stakes business strategy. Okay, so here's the bottom line. FirstCry's main business in India is a profit-generating powerhouse. But instead of just banking all that cash, the company is making a huge bet on the future. They are pouring that money into aggressive expansion, acquiring other companies, and pushing hard into new international markets. It's a high-risk, high-reward strategy. You sacrifice your profits today for a chance to totally dominate the global market tomorrow.
And that leaves us with the big billion-rupee question, doesn't it? Is this high-cost, high-risk strategy the right move? Is it smart to fund a massive global expansion using the profits from a stable core business? Well, only time will tell if this enormous gamble actually pays off.